Okay, guys, so in today's lecture, we'll be looking at Unit 2 on consolidations. So last week, you would have started with Unit 2, Week 1. Now we're going to be doing Week 2 of that unit, okay? Please can someone just type in the chat box, were you able to bypass the lobby? Because some people are coming via the lobby and I'm not going to be able to admit people at 5 past. Okay, so everyone needs to join. You should be able to bypass the lobby. So I'm not sure why people are coming via the lobby still. Okay. So in this lecture, we are going to be looking at consolidations. So this is lecture 3 of 5. So you would have started with Unit 1, and there you would have looked at the introduction to groups. And then last week, you would have looked at some beginning parts of consolidations. And then this week, we'll be continuing with consolidations, and we'll be looking at a situation where we have non-controlling interest. So last week, we would have looked at a situation where it was a wholly owned subsidiary. This week, we're going to be looking at a situation where we have non-controlling interest. Okay. Ryan, I see your hand is up. Maybe you can just type in the chat box what the question is. Maybe it's something to do with the lobby. You guys can just type in the chat box for me. Okay. So let's have a look at this diagram here. Okay, so here we have a diagram of a group of companies, and we have the Alpha Group. We have Alpha Limited owns 55% in Cat Limited and 55% in Beta Limited. And then we'll see the company Gamma. They own 45% in Beta Limited. So here in this scenario, Gamma Limited is actually known as the non-controlling interest. So Gamma Limited is the non-controlling interest, and it means that they own a minority shareholding in Beta Limited, whereas Alpha Limited owns a controlling number of shares. Gamma Limited only owns 45% of the shares. So what is a business combination, or what does IFRS require us to do when we have a business combination? So we need to use the acquisition or purchase method for all business combinations. So as part of a business combination, we need to identify all the assets acquired and identify all the liabilities assumed. And then we need to identify, are there any possible contingent liabilities? So remember, we are looking at these things in the company that is being acquired. So we're identifying, are there any assets? We are identifying the liabilities, and then we're identifying any possible contingent liabilities. Then the process is to measure that all of these assets and liabilities at the acquisition date, they must be measured at fair value. The next thing we need to do is that we need to identify any non-controlling interest in the acquirer. So what is the shareholding that the parent company owns? And then we need to identify what is the portion that the non-controlling interest owns. So the non-controlling interest, this is the portion of the net assets of the entity relating to shares that are not held by the parent. Okay. So the parent will own a number of shares, usually like it could be 60% or it could be 80%. Then the portion that is not owned by the parent, this is going to be referred to as the non-controlling interest. So the non-controlling interest is measured at the non-controlling interest's proportionate share of the acquiree's identifiable net assets. Okay, so we are going to measure the non-controlling interest at their share of the acquiree's identifiable net assets. Then we need to calculate if there's any goodwill in the acquisition. So we'll know how much was paid for the shares, and then we'll compare that to what was acquired. So we need to calculate, is there going to be goodwill in the acquisition, or is there going to be a gain from bargain purchase? So to do this, we calculate the difference between the sum of the consideration paid, any non-controlling interest, and any previously held equity interest at fair value, and the fair value of the identifiable net assets acquired. So we are comparing the two, and we are going to see is there goodwill or is there gain from bargain purchase. So if the consideration paid and any non-controlling interest is greater than the fair value of the net assets acquired, then we have goodwill. However, if the net assets acquired at fair value are greater than the consideration paid and any non-controlling interest, then we have a gain from bargain purchase. So what is non-controlling interest? So remember that where the parent does not acquire the full share capital of the subsidiary, in other words, it is not wholly owned, the owners other than the parent, these are referred to as the non-controlling interest, okay? So we can have a company that is owned by 60%, that is the parent, shareholding, which will be 60%. And then we can have the other 40%, which is owned by minority shareholders. They are called the non-controlling interest. So a subsidiary that is not 100% owned by the parent is called a partially owned subsidiary. So in this week's lecture, we'll be looking at partially owned subsidiaries and how to deal with that using the normal procedure that you would have used last week, the analysis of equity, and how to deal with the financial statements and the journal entries. So the non-controlling interest, this is the equity in a subsidiary not attributable directly or indirectly to the parent. Okay, so you know what the non-controlling interest is. So when preparing consolidated financial statements for a group, we must identify the non-controlling interest share in the assets and liabilities of the subsidiary, as well as the non-controlling interest share in profit or loss. And this must be shown separately from the ownership interest of the parent. So we need to show the non-controlling interest with an equity separately from the equity attributable to the owners of the parent. So we need to show so in equity in the consolidated financial statements. Can you guys hear me? Okay, great. Just checking. Sorry, Apiwe, I think it must be on your, sorry, Offense, it must be on your side. Everyone else seems to be able to hear me. Okay, make sure you just can hear. It is recorded though, if for some reason you came late and you want to catch the beginning. Okay. So in equity, we are going to show the non-controlling interest separate to the parent's equity. Totals for each reserve account. So in our statement of financial position, in the equity part, we're going to show the non-controlling interest, and we're going to show the portion that belongs to the parents. We're also going to show totals for each reserve account, including retained earnings that are brought across from the statements of changes in equity. So you'll prepare the statement of changes in equity, and those totals will agree to the statement of financial position. So the non-controlling interest, this is going to be shown as a single line item within equity in the statement of financial position. So this is an example here of a consolidated statement of financial position for the Alpha Group. So you can see we have our assets, we have property, plants, and equipment. So the group has inventory, trade receivables, bank. All of these would be taken from the parent plus the subsidiaries. Then we have equity attributable to owners of the parent. So we have share capital and retained earnings here. And then the non-controlling interest, this is going to be shown as a line item in the statement of financial position. Okay, so in our consolidated group statements, we are going to have non-controlling interest. But remember, the non-controlling interest, this will not be shown in the separate financial statements of the parent and the separate financial statements of the subsidiary. So the non-controlling interest will only be shown in the consolidated financial statements. So in order to calculate the amount, which should be shown in the consolidated statement of profit and loss and other comprehensive income, consolidated statement of changes in equity, and the consolidated statement of financial position, we need to do an analysis of owner's equity. Okay, so we are going to do an analysis of the owner's equity. Okay. Okay, someone has said the sound is choppy. Can you guys hear me better now? Okay, please confirm if you can hear me okay. Okay. So let's continue, guys. I think if the sound is choppy, it's on your side. So here we have lecture example 1 on slide 12. Okay, so let's just follow. So on 30 September 2020, PPTY Limited acquired 64,000 shares in SPTY Limited and paid 80,000 Rand. On this date, SPTY Limited had 80,000 shares in issue. The respective statements of financial position of the two companies for the year ended 30 September 2020 are as follows. So here we have the statement of financial position for PPTY Limited and the statement of financial position of SPTY Limited. Okay. So you can see both companies have assets, both companies have equity, both companies have liabilities. So the 80,000 shares, so remember that PPTY Limited acquired 64,000 shares and they paid 80,000 Rand. S had 80,000 shares. So S has 80,000 shares and P bought 64,000 of those shares. So if I were to ask you what is the shareholding, what is the percentage that P owns in S, you're going to take the 64,000 and you're going to say 64,000 as a percentage of 80,000, and that is going to give us 80%. So P owns 80% in S. But who owns the other 20%? So the non-controlling interest owns the remaining number of shares, which is 16,000 shares. So 16,000 as a percentage of 80,000, and this will give us 20%. So here, P owns 80%, and the non-controlling interest owns 20%. So the investment in S of 80,000 Rand in the books of PPTY Limited, this represents their 80% investment in the equity of S, okay? So remember we said P owns 80%. They bought 64,000 shares. They didn't buy all the shares. They only bought 64,000 shares, and that represents 80% of the ownership in S. So remember that P paid 80,000 Rand for this 80% ownership, okay? Not 100%. So P only owns 80%. So that 80,000 that they paid, that represents 80% of the investment, not 100%. So S is equity. If we go back to that statement of financial position, remember they showed the statement of financial position for Pty Limited and S Pty Limited. So the share capital, S has 80,000 Rand in share capital and 20,000 Rand worth of retained earnings. Okay, so this is S's equity. So P doesn't own 100% of the share capital of S. Remember we said that P owns 80% because that is what they bought. So it's not a wholly owned subsidiary in this scenario. So in order to calculate the values for our pro forma journal entries at acquisition, we need to prepare the analysis of owner's equity of the subsidiary, okay? So this is going to be a calculation that we do to help us work out how much P owns and how much is attributable to the non-controlling interest. Then we're going to perform our pro forma journal entries. So we're going to use the analysis of owner's equity to help us perform our pro forma journal entries. So remember the pro forma journal entries, these are only done when the group financial statements are prepared. The pro forma journal entries do not appear in the books of Pty Limited or SPTY Limited. They are simply done as part of the consolidation procedure at the end of the year when preparing consolidated financial statements. So SPTY Limited will still prepare individual financial statements and PTY Limited will prepare their separate financial statements. And then a consolidation procedure will be done where the analysis of owner's equity will be prepared, and then we'll do the pro forma journal entries to prepare the consolidated financial statements. So this is what the analysis of owner's equity looks like. So in our example, in lecture example 1, we are taking the share capital and retained earnings. We are taking the equity of S, which consists of share capital of 80,000 and retained earnings of 20,000. And then we'll total that. We can see that S's equity is 100,000, okay? And remember we said that P acquired 80%. P owns 80%. So we are going to take the share capital in S, which is 80,000, and we're going to multiply it by the 80% that P owns, and then we're attributing 80% of the share capital in S to P. So P owns 64,000 Rand. We calculated that by taking the share capital of 80,000 multiplied by the 80%, and that gave us 64,000 Rand. Then the non-controlling interest owns the rest. So if P owns 80%, we know that the non-controlling interest is 20%. So we are going to take that 80,000 of share capital multiplied by 20%, and therefore that is going to give us the non-controlling interest share in the share capital. And then we're going to do the same with retained earnings. So remember that S had 20,000 of retained earnings in their separate financial statements. So we are going to say P owns 80% of that 20,000. So we're going 20,000 multiplied by 80%, and that will give us the 16,000 Rand. Then we have the non-controlling interest, which is 20%. So that 20,000 of retained earnings in SPTY Limited, we are saying 20,000 multiplied by the non-controlling interest of 20%, and that will give us 4,000 Rand. So then we will total up. So if we take P's column, so this is P's column here. Remember, we have the total equity in S in this total column. Then we have P's 80% ownership in this column next to it. Then we have the non-controlling interest, which is 20% in the final column. So then we can work out here what is the consideration paid. So remember we said that P paid 80,000 Rand. So we need to work out, is there goodwill or is there gain on bargain purchase in this scenario? So we are going to compare the consideration paid, which is 80,000, to what P purchased, which is 80,000. So here we are simply comparing these two numbers. P paid 80,000 Rand and they acquired equity worth 80,000 Rand. So here they paid exactly what they got. So in this scenario, there is no goodwill or gain on bargain purchase because they acquired 80,000 Rand worth of equity in S and they paid 80,000 Rand for that equity. Okay, so here you can see that there is no goodwill or gain on bargain purchase. But in a test or exam, you must just check because it's likely we want you to work out the goodwill or the gain on bargain purchase. So in a test or exam, it's unlikely there wouldn't be goodwill or gain on bargain purchase. So you would just want to check your calculations in that scenario. Okay, so let's look at step 1 in this example 1. So in step 1, now we want to perform the pro forma journal entries. So remember, we are calculating the pro forma journal entries here we are calculating the pro forma journal entries. We want to eliminate the share capital and retained earnings in S. Okay, so we are doing the pro forma journal entries here. We are saying debit share capital, 80,000 Rand. Debit retained earnings, 80,000 Rand. So we are simply eliminating here the equity that P has in S. So the debit is the elimination of 100% of the equity. So remember, the equity is the retained earnings and the share capital and the other reserves of the subsidiary at acquisition. So we're simply debiting the share capital and the retained earnings, and we are eliminating 100% of the equity of the subsidiary at acquisition. Then we are crediting the investment in S. So we are crediting the investment in S Limited with 80,000 Rand. And we are doing this because we need to eliminate the parent's cost of investment in the subsidiary, which is the consideration transferred by the parent to acquire the 80% of the subsidiaries at acquisition equity. Okay, so we have debited the equity of the subsidiary and we are crediting the cost of the investment in the subsidiary. Now, if we compare those two, you can see that we still need to raise the non-controlling interest, okay? So we need to raise the non-controlling interest, which is 20,000 Rand. So if we go back to our analysis of owner's equity, you can see that the non-controlling interest is 20,000 on acquisition. So we are going to credit non-controlling interest with 20,000. So you can see that these journals balance. Your debits equal your credits, which means there's no goodwill or gain on bargain purchase in this scenario. Okay, so this is the pro forma journal entry. Let's have a look at the next slide. So these are just some explanatory notes here, okay, which I've already explained. So you guys can just revisit this in your own time because I have explained the journals. Now we need to prepare the consolidated statement of financial position. So remember, we have prepared the analysis of equity, then we have done the pro forma journal entries. Now we need to prepare the consolidated statements of financial position. And we're going to do this by adding 100% of P to 100% of S on a line-by-line basis. So we are going to add the assets of P plus the assets of S. We're going to add the liabilities of P plus the liabilities of S. Then we're going to look at the equity section. So the equity section must consist of the equity attributable to owners of the parent, and then equity attributable to the non-controlling interest. So we need to split the equity between the parent and the non-controlling interest, which we'll call NCI. Okay, so this is the consolidated statement of financial position. It looks like confusing if you look at it, but if we just go through it step by step, then it will make sense. Okay. So here we have the consolidated statements of financial position. So we are going to add all of the assets, liabilities, and equity for P plus the assets, liabilities, and equity of S. And then we also need to take into account the pro forma journal entries. Okay, so let's start with property, plant, and equipment. So here, P has property, plant, and equipment of 23,000, and S has property, plant, and equipment of 50,000. So we are going to go P plus S, and that will give us a consolidated figure of 73,000 Rand. Then remember, we processed the pro forma journal entry. We said we were crediting the investments, okay? So if we go to the investments in the subsidiary, if we go back over here, you can see that P had an investment in the subsidiary of 80,000 Rand, okay? So we are now going to put that into our consolidated statement of financial position. But then remember, we processed in our pro forma journal entries a credit to investment in subsidiary of 80,000 Rand. So we're saying P has 80,000 Rand plus 0 in S minus 80,000 Rand, and that will give us a consolidated investment in the subsidiary of 0. Okay, so essentially what we're doing is we have eliminated that investment in the subsidiary. Then we are going to look at our trade receivables. So P had 107,000 Rand worth of trade receivables, and S has 86,000 Rand worth of trade receivables. So we're going to say P plus S, and that is going to give us a consolidated figure of 193,000 for trade receivables. Okay, so that is our assets. That is our total assets. If we add up our total assets of 73,000 plus 193,000, that will give us 266,000. So that is our consolidated total assets. Then we have our equity. So we have equity attributable to owners of the parents, and then we'll show the non-controlling interest separately. But let's just go through line by line. So if we look at share capital, and if you look back to slide 13, the share capital of P is 100,000. And then if you look at the share capital of S has 80,000 Rand worth of share capital. So we are going to go P 100,000 Rand plus S, which is 80,000 Rand. And then we need to ask ourselves, was there a pro forma journal entry processed? So yes, there was. Remember, we processed the pro forma journal entry where we debited share capital. So we debited share capital. If we go back to the slides, remember we debited share capital and debited retained earnings. So this is our pro forma journal entry. So now we are putting that in our consolidated statement of financial position here to get the final figure. So we're saying we debited share capital with 80,000, which essentially it cancelled out the share capital, S's share capital. So here we're saying share capital P has 100,000 plus S is 80,000 minus the 80,000 in the pro forma journal entry, and that will give us 100,000 Rand of share capital in our consolidated statement of financial position. Then we have retained earnings. So P has retained earnings of 26,000. S has retained earnings of 20,000. And then remember, we process pro forma journal entries of 20,000 Rand. So we are saying 26,000 Rand of P, and then 20,000 Rand of retained earnings in S, minus the 20,000 in the pro forma journal entry will give us a consolidated retained earnings figure of 26,000. So this is the equity that is attributable to the parent. Now we need to show what is the equity that is attributable to the non-controlling interest. And it is 20,000. So remember, when we did our pro forma journal entries, we credited non-controlling interest with 20,000 Rand. We were giving NCI their portion of the equity. So we are now showing that in the consolidated statement of financial position. We are saying non-controlling interest is 20,000 Rand, and that is NCI's portion. So if we add up the portion that belongs to the parent, it is 126,000 plus the non-controlling interest portion, which is 20,000. It gives us a total consolidated equity figure of 146,000. Okay, so we have dealt with the assets and we have dealt with the equity. Now let's have a look at the liabilities. So here we have trade and other payables, and trade and other payables, P had 84,000 Rand in their separate financial statements, and then S had 36,000 in their separate financial statements. So we are simply adding P plus S. So we're saying 84,000 Rand plus 36,000 Rand, that will give us 120,000 Rand consolidated trade payables. So this is the consolidated statement of financial position. Okay, so when you do this in a test or exam, it's very important to show your workings, because all of these numbers, like when you take the PPE 23,000 plus the 50,000 together, we want to know what you added, okay? So if you, for some reason, get this consolidated figure wrong, if you showed us your workings, it means we can give you part marks, okay? So it's very important that you show us your workings. Don't just give this last column here. You must actually give us the workings which show how you got to that consolidated column. Okay. And then everything in this page highlighted in red, this is from step 1. So all the items highlighted in red, those come from your pro forma journal entries. Okay, so it's really a process. If you can't do your analysis of equity, you'll struggle with your pro forma journal entries, and you'll struggle with your consolidated statement of financial position. Okay, so it's important that you know how to do your analysis of equity, and you'll see that this is not going to be asked for, but it is part of your workings. So you must always do it, even if it's not asked for. You must do it because it's your working, it's your calculation. It will help you get the figures. Okay. I'm just looking at some of the questions in the chat. The first question, I think with this example here, remember we said that we didn't have a goodwill or gain on bargain purchase. So remember, this is the analysis of owner's equity. Because the consideration paid was 80,000 and P acquired 80,000, there is no goodwill or gain on bargain purchase in this scenario. Okay. So if you look here at the slide, the question was goodwill is a loss since a profit is a gain in bargain. Okay, so I'm not 100% sure what the question is, but I'm thinking maybe it's to do with this scenario here. Like maybe in the previous lecture, you saw how to calculate goodwill or gain on bargain purchase. But in this scenario, there is no goodwill or gain on bargain purchase because the consideration paid is the same as what we acquired. So remember, goodwill will only arise if the consideration paid is more than the parent's share in equity, and the gain on bargain purchase will arise if we are getting more than what we have paid for. Okay. Then there's another question from T-Man. Investment in subsidiary has to always be negative on the consolidated statement of financial position. Okay, that's not really correct. I think what you're referring to, here is the pro forma journal entries. Okay, so when you look at the pro forma journal entries on slide 21, if you look at the consolidated statement of financial position, so here we have P's investment in S, which is 80,000, and then S has 0. We are showing the pro forma journal entry. We are eliminating that investment in the subsidiary. So the consolidated column, this is your final figures in your statement of financial position, that is 0. So we have essentially eliminated the investment. It's not that we're showing the investment as a negative. We are eliminating the investment. So we have 80,000. By processing the pro forma journal entries, we are eliminating that 80,000, and that will give us a consolidated figure of 0 for the investment in the subsidiary. So we are eliminating it by processing the pro forma journal entry. Okay, so we're not showing it as a negative. We're simply showing the pro forma journal entry, which is an elimination. Okay, but thank you for asking. It's a good question. So let's now have a look at the statement of changes in equity. So the statement of changes in equity must only show amounts that are attributable to the parent in the reserve accounts. And then we're going to have a separate column of total equity of parent. So we're going to show the share capital, the retained earnings. We're going to show those things that are attributable to the parent. And then we're going to have a column which says total equity of the parent. Then we're going to have the non-controlling interest. And then we're going to add the parent's column, the total equity of the parent. We're going to add that to the non-controlling interest, and that will give us total equity of the parent and non-controlling interest equity in one column, which is called total equity. So this is our consolidated statement of changes in equity. And they gave us the figures on 30 September 2020. And remember, they actually said to us that P acquired 64,000 shares in S on the 30th of September 2020. So on the last day of the year, P acquired 80% in S. So that is why there's no opening balance for non-controlling interest. So there's no opening balance for non-controlling interest, because there was no non-controlling interest at the beginning of the year. The acquisition of the subsidiary happened later on. But let's have a look at this whole statement here. So we have share capital. This is P share capital. If you go back to slide 13, which shows the statements of financial position of the separate companies, you'll see here that the share capital at the end of the year is 100,000, and the retained earnings at the end of the year is 26,000. Then, in the statement of changes in equity here, they have total comprehensive income of 16,000, and a dividend paid of 4,000. Okay, so this information seems to be assumed. It doesn't seem to be in the required, but we would give this to you in a test or exam. They're just showing that when you have total comprehensive income of 16,000, that will go here in the retained earnings column. And then you have a dividend paid of 4,000, which will reduce the total comprehensive income. Okay, so the share capital column here and the retained earnings column here, these belong to the parent. And then we'll total those two columns. So it says equity attributable to owners of the parent. So here we will add the opening balance of the share capital, which is 100,000, plus the retained earnings of 14,000, and that will give us 114,000 in this total column, which is equity attributable to owners of the parent. Then for total comprehensive income, we'll total this, and that will give us 16,000. And then we have the dividend paid of 4,000, which we'll also show in this total column. Then we have the end of year balance. So we have share capital of 100,000 plus retained earnings of 26,000, and that will give us an amount of 126,000. So this total here, this is the total of the equity that is attributable to owners of the parent. Okay, now we need to show the non-controlling interest. So the non-controlling interest, remember we said there's no opening balance because the acquisition of the subsidiary only happened on the last day of the year. So on the last day of the year, we had the 20,000 Rand acquisition of the subsidiary, and we said the 20,000 is attributable to the non-controlling interest. So now at the end of the year, the non-controlling interest is 20,000 Rand. And now that we have our total equity attributable to the parents, and we have our non-controlling interest, we'll simply add these two together to give us total equity. So we'll say equity attributable to owners of the parent plus non-controlling interest. That will give us total equity. And then total comprehensive income, which is 16,000. There's nothing in NCI, so that will give us total comprehensive income in the total equity column of 16,000. Then we have a dividend paid, which is 4,000 Rand in equity attributable to owners of the parent. There's nothing in the non-controlling interest column, so we'll have total dividend paid of 4,000 Rand in the total equity column. Then we have acquisition of subsidiaries. So remember we said the non-controlling interest share was 20,000. This is part of the pro forma journal entries, this 20,000. So we'll put that in the total column. And then if we total up this total equity column, we take the opening balance plus the total comprehensive income minus the dividend paid plus NCI, that will give us a balance of 146,000. Okay. So just note here that this dividend paid, this is only the dividend paid by the parent. Okay, so remember we said that these two columns are showing P's equity. So therefore this 4,000 Rand, this is the 4,000 Rand dividend that is paid by the parent. Okay. So this is the consolidated statement of changes in equity. But you can't just do this without doing the analysis of owner's equity. So the analysis of owner's equity helps us do the consolidated statement of financial position and the consolidated statement of changes in equity. Let's now have a look at example 2. So in example 2, okay, we're on slide 24 if you guys want to follow. On 31 March 2020, PTY Limited acquired 64,000 shares in SPTY Limited and paid 85,000 Rand. On this date, SPTY Limited had 80,000 shares in issue. The respective statements of financial position of the two companies as at 31 March 2020 are as follows. So here we have the statement of financial position, and remember this is P's separate financial statements, and then this is S's separate financial statements. So these are P will prepare their separate financial statements at year end, and S will prepare their separate financial statements at year end. So we now want to prepare the consolidated financial statements. The first thing we need to do is to see, well, how much does P own of S? So P acquired 80,000, sorry, S has 80,000 shares and P acquired 64,000 of those shares. So it means P has 80% in S. So P acquired 64,000 shares and S has a total of 80,000 shares. So it means that P owns 80% in S. And then again, we have non-controlling interest. They own 16,000 shares out of S's 80,000 shares. So the non-controlling interest is therefore 20%. So the investment in S of 85,000 Rand in the books of P represents their 80% investment in the equity of S. So this means that the investment in S is 85,000 Rand. So this is the amount that P paid for 80% shareholding in S. S's equity on acquisition date. So S has share capital of 80,000 Rand and retained earnings of 20,000 Rand. Let's have a look at our analysis of owner's equity. So the analysis of owner's equity of S, so we're going to follow the same process here as we did in the previous example. This total column here, we are going to start with the equity in S. So S has share capital of 80,000 Rand and P owns 80% of that. So if we take 80,000 Rand multiplied by P's ownership, which is 80%, that will give us 64,000 Rand. Then we need to work out the non-controlling interest. If P owns 80% in S, it means that the non-controlling interest is 20%. So we are going to apportion the non-controlling interest, their share of S's equity. So 80,000 Rand multiplied by 20,000 Rand, that will give us 16,000 Rand. So the NCI has 16,000 Rand. Retained earnings is 20,000. So S's retained earnings is 20,000. P owns 80% of that. So we'll say 20,000 multiplied by 80%. That will give us 16,000 Rand. This is 80%, which belongs to P. Then we have the non-controlling interest. So the retained earnings of S is 20,000 multiplied by the NCI share of 20%, that will give us 4,000 Rand. So now we can total up, we can do a total column. We're showing the total equity that S has, which is 100,000. P owns 80% of that. So we're adding these two numbers here, the 64,000 and the 16,000, and that will give us 80,000. And then the non-controlling interest, their 20% ownership will give them share capital of 16,000 and retained earnings of 4,000 Rand. And that will give us a total amount attributable to the non-controlling interest of 20,000. So now we need to work out, is there goodwill or gain on bargain purchase? Remember we said that P paid 85,000 Rand. So P paid 85,000 Rand. They got equity worth 80,000 Rand. Is this goodwill or is it gain from bargain purchase? You guys can type in the box. Is it goodwill or is it gain from bargain purchase? Okay, well done, everyone. It is goodwill, okay? Because the consideration paid is greater than what P received, there's obviously goodwill or some other thing that they are getting. So we have goodwill. So when the consideration paid is greater than P's share of equity in S, it means we have goodwill. And what is goodwill? How do we record it? So remember, goodwill is an asset. Okay, goodwill is an asset. And remember, goodwill will be shown in the consolidated statements, but in P's separate financial statements and in S's separate financial statements, they will not have goodwill. This goodwill here that we are calculating, this will only be shown in the consolidated financial statements. Okay, so there's a good question here from Patience Lorato. If there was a revaluation, we were going to add it to our analysis, okay? So I'm assuming you're talking about a revaluation maybe of property. So remember, on acquisition date, all the assets and liabilities have to be recorded at fair value. So it is possible that we will have to perform a revaluation of our property on acquisition date. Okay, so so that would obviously affect the equity amounts in your analysis of owner's equity. Okay, that's a good question. So we have calculated our goodwill. Let's now have a look at our pro forma journal entries. So we need to calculate we are doing step 1, the pro forma journal entry to eliminate the investment in SPTY Limited in P's books and SPTY Limited's equity. So here we are doing our pro forma journal entries. We are debiting share capital with 80,000. And we are debiting retained earnings with 20,000. So remember the debit here, these debits to share capital and retained earnings, this is the elimination of 100% of the equity of the subsidiary at acquisition. So here we are eliminating the share capital and retained earnings of the subsidiary, which is S, on acquisition. Then, similar to the previous example, we are going to credit the investment in S. So we are going to credit the investment in S with 85,000 Rand because that is what was paid. So the credit this is simply eliminating the parent's cost of investment in the subsidiary, which is the consideration paid by the parent to acquire the 80% in the subsidiary. So P paid 85,000 Rand to acquire 80%, and that's fine in the separate financial statements of P. But in the group financial statements, we cannot show this investment because P and S are seen as one company. So on consolidation, P and S are seen as one company, and it doesn't make sense. You cannot own an investment in yourself. So here we are crediting investment in SPTY Limited with 85,000. We are crediting non-controlling interest with 20,000. So remember, we gave the NCI their portion. Over here, we gave them 20% of the share capital and 20% of retained earnings. That 20,000 Rand, that is a credit. So here we are simply recognizing the portion of the subsidiary at acquisition, the equity that belongs to the non-controlling interest. And the goodwill that we calculated, no goodwill is attributable to the non-controlling interest here. So this goodwill, remember, this is attributable, this arises on acquisition in the consolidated statement of financial position. Okay, so if you take your debits here and your credits, they only balance because of the goodwill that we calculated. So we are debiting goodwill with 5,000 Rand. So remember, this goodwill is an asset and it is going to be shown on the consolidated financial statements. Okay, so that is the pro forma journal entries. This is just an explanation of the pro forma journal entries that we have already gone through. Now we need to prepare the consolidated statements of financial position. So here we are simply adding 100% of P with 100% of S on a line-by-line basis for assets and liabilities. And then the equity section, we are going to split it. We are going to show the equity that is attributable to the owners of the parent and the non-controlling interest. And remember, when we prepare the consolidation, we also take into account the pro forma journal entries. Okay, so this is the consolidated statement of financial position. So if you look at slide 25, that shows the separate financial statements of P and the separate financial statements of S. Here we are consolidating those, and we are seeing the company as one company. And in order to see it as one company, we also have to do our pro forma journal entries. So P has property, plants, and equipment of 23,000. S has PPE of 50,000. We're going to say P 23,000 plus S of 50,000. That will give us 73,000. Then we have our investment in S. P has an investment of 85,000 Rand in the subsidiary in S. And then remember, we processed our pro forma journal entry. We eliminated this amount on consolidation by processing our pro forma journal entries. So we are going to say 85,000 Rand in P, which is an investment. S has nothing, minus 85,000. That will give us a total investment in the consolidated financial statements of 0. Then we have goodwill. Remember, we said that P Limited and S Limited won't show this goodwill in their separate financial statements. It'll only be shown in the group financial statements. So we have goodwill as a pro forma journal entry, which is 5,000 Rand. Then we have trade receivables. So trade receivables, P has 102,000 Rand worth of trade receivables. S has 86,000 worth of trade receivables. So we're going to say 102,000 plus 86,000. This will give us 188,000 Rand. This is the total consolidated trade receivables. Then we have equity. So here, remember, we said we have to show equity, which is attributable to the parent, and the portion that is attributable to the non-controlling interest. So P had share capital in their separate financial statements of 100,000, and S had 80,000 Rand worth of share capital in their separate financial statements of 80,000 Rand. Remember, we processed that pro forma journal entry. We said debit share capital in S. So we're going to say 100,000 plus 80,000 minus 80,000. And that will give us 100,000 Rand consolidated share capital. Then we have retained earnings of 26,000 Rand in P Limited, 20,000 Rand in S Limited, minus 20,000 Rand in the pro forma journal entries. So we're going to say P 26,000 plus S 20,000 minus 20,000, and that will give us 26,000 Rand in the consolidated statement of financial position. So if we add the 100,000 plus the 26,000, that will give us 126,000 in the consolidated financial statements. That is equity that is attributable to owners of the parent. Then we have the non-controlling interest. Remember, in our analysis of owner's equity and our pro forma journal entries, the non-controlling interest owns 20%, and that is 20,000 Rand in this scenario. So NCI, we recorded this as part of the pro forma journal entries. So remember that this non-controlling interest does not appear in the separate financial statements of P Limited and S Limited. The 20,000 is recorded as non-controlling interest in the consolidated financial statements. So if we add up the parent's portion, so equity attributable to owners of the parent is 126,000 plus 20,000, which is attributable to NCI. That gives us total equity of 146,000. Then we have trade and other payables. So trade payables is 84,000 Rand. P Limited at 84,000 Rand trade payables in their separate financial statements. S has 36,000 in their separate financial statements. So that gives us a consolidated figure of 120,000. Okay, so this is the consolidated statement of financial position. And remember, everything highlighted in red is from step 1, which was the pro forma journal entries. Okay, so again, this is the consolidated statement of financial position. Now we need to have a look at the statement of profit or loss and other comprehensive income. So net profit or loss attributable to the non-controlling interest must be shown separately in the statement of profit or loss. The total comprehensive income attributable to the non-controlling interest must also be shown separately in the statement of profit or loss and other comprehensive income. So now we are going to look at the group statement of profit or loss and other comprehensive income. And just like we showed non-controlling interest in the consolidated statement of financial position, we are also going to show non-controlling interest in the statement of profit or loss and other comprehensive income. So for this example now, we're going to continue with example 2. They are giving us some more information, okay, relating to the statement of changes in equity. So P earned a net profit after tax of 26,000 during the period ended 31 March 2020 and declared and paid dividends of 8,000 Rand. And SPTY Limited earned a net profit after tax of 12,000 Rand during the period ended 31 March 2020 and declared and paid dividends of 2,000 Rand. So the consolidated statement of changes in equity will therefore be as follows, okay? So here we have a statement of changes in equity. And remember that this acquisition took place on the last day. So let's have a look at share capital. So remember that the share capital and retained earnings column, these shows P's equity. So share capital, P had an opening balance of share capital of 100,000 and they had a closing balance of share capital of 100,000. The retained earnings here, they gave us the closing balance on slide 25, and the closing balance of retained earnings was 26,000. And they told us that P had total comprehensive income of 26,000 Rand after tax, and they declared and paid a dividend of 8,000 Rand. So total comprehensive income is 26,000 Rand. The dividend paid is 8,000 Rand. So if we work backwards, take the 26,000 plus the dividend paid minus the total comprehensive income, that will give us the opening balance on retained earnings. So this is the share capital and retained earnings of the parent. Now we can add those two together to give us the column equity attributable to owners of the parent. So we're simply adding the opening balance 100,000 plus the 8,000 Rand. That will give us 108,000 Rand. Then we have the total comprehensive income, which is 26,000. And then that will go in the total column. Then we have a dividend paid by P, which was 8,000. That will also go in the total column. Then we have our closing balance here. So we'll take the closing balance of share capital of 100,000 plus the retained earnings of 26,000, and that will give us 126,000. Then we have our non-controlling interest column. So remember the acquisition of subsidiary resulted in 20,000 Rand of non-controlling interest. So our NCI column is 20,000. And then we have our total equity column, where we're simply adding the equity attributable to owners of the parent with a non-controlling interest. Okay, so we're saying 108,000, that'll go in the total equity column. 26,000, that will go in the total equity column. Then 8,000 Rand in the total equity column, NCI 20,000 in the total equity column, and then we're adding 126,000 plus the 20,000. That will give us 146,000. Okay, so remember that the subsidiary was acquired on the last day of the reporting date. Therefore, the subsidiary's profits are not consolidated in this question. So the consolidated statement of profit or loss and other comprehensive income, this will show 100% of P Pty Limited only, as none of the profits of S will be attributable to P because the subsidiary was acquired on the last day. Okay, next week, we'll look at how to work out the pre-acquisition profits. Okay. So let's now have a look at the last example in our lectures. So on 31 October 2020, P Limited acquired 60,000 shares in SPTY Limited and paid 140,000 Rand. On this date, SPTY Limited had 80,000 shares in issue, and PPTY Limited considered their assets and liabilities to be fairly valued. The respective statement of financial position of the two companies as at 31 October 2020 were as follows. So here we have the statement of financial position for PPTY Limited and the statement of financial position for SPTY Limited. Okay, so now it says here P earned a net profit after tax of 180,000 Rand in the period ending 31 October 2020 and declared and paid dividends of 20,000 Rand. S earned a net profit after tax of 60,000 Rand in the period ending 31 October 2020 and did not declare any dividends. So let's have a look at the shareholding. So S has a total of 80,000 shares. Okay, this is the share capital of S. P acquired 60,000 shares. If P owns 60,000 shares out of the 80,000 shares, that is 75%. So P owns 75% in S. Therefore, the non-controlling interest are the other minority holders. They own 20,000 shares. So if we say 20,000 as a percentage of 80,000, we'll see that the non-controlling interest own 25%. So here P owns 75%. So the first thing we need to do, we need to eliminate the investment in S. So the investment in S is 140,000 in the books of P. This represents their 75% investment in the equity of SPTY Limited. So we need to eliminate this, okay? Remember, S's equity consists of 80,000 Rand worth of share capital and retained earnings of 120,000 Rand. So let's have a look at our analysis of owner's equity. So remember we said S's equity goes in this total column. S had total share capital of 80,000 Rand and retained earnings of 120,000 Rand. P acquired 75% of the share capital. So we'll say 80,000 Rand multiplied by 75%. And that will give us 60,000 Rand. P owns 60,000 of the share capital. Then we have retained earnings of 120,000 multiplied by 75%, and that will give us 90,000 Rand. Then we need to work out what is the non-controlling interest share. So we are going to take the share capital of 80,000 multiplied by the 25%. Remember the non-controlling interest is the 25%, and that gives us 20,000. So NCR owns 20,000 Rand worth of the share capital. We'll do the same for retained earnings. So the total retained earnings in S is 120,000 multiplied by 25%, and that will give us 30,000 Rand. So NCR owns 30,000 Rand. Now we can total up. So the total equity that S has is 200,000 Rand. The total equity that P has in S is 150,000 Rand. And NCR's share in the equity of S is 50,000 Rand. And remember we said that P paid 140,000 Rand to acquire their 75% in S. So the consideration paid here is 140,000 Rand. So we need to work out, is there goodwill here or is there a gain on bargain purchase? So is there goodwill here or is there a gain on bargain purchase? So remember the consideration here is less than P's total net asset value in S. So we're saying P paid 140,000. They got 150,000 Rand share in the equity of S. Therefore, they paid less than what they got. That's how it appears. So this is a gain on bargain purchase. So we have a gain on bargain purchase here. And remember, the gain on bargain purchase, this is shown as the gain on bargain purchase is an income in the statement of profit and loss. Okay, so remember we said goodwill is an asset, and this is only shown in the consolidated financial statements. It is the same with gain on bargain purchase. So the gain on bargain purchase is only shown in the consolidated financial statements. Now we have our pro forma journal entries. We need to eliminate the investment in S Pty Limited in P Pty Limited's books and S Pty Limited's equity. Okay, so it sounds confusing, but if we go through it line by line. So if we are debiting share capital with 80,000, this is S's share capital, and we're debiting retained earnings with 120,000 Rand. So we're doing this debit to eliminate 100% of the equity of the subsidiary at acquisition. So we're eliminating the equity of S on acquisition. Then we have the investment in S Limited. So remember, in P's books, they had an investment of 140,000 Rand. So the credit is the elimination of the parent's cost of the investment in the subsidiary, which this is ultimately the consideration paid by the parent, which is P, to acquire 80% of the subsidiaries at acquisition equity. So P paid 140,000 Rand to acquire 75% of the equity in S, and that is shown in P's separate financial statements. However, on consolidation, P and S are seen as one company. Therefore, we cannot show this investment. We need to eliminate it. So we are crediting investment in S Limited with 140,000 Rand. Then we are crediting the non-controlling interest with 50,000 Rand. This comes from the analysis of owner's equity here of 50,000. So we are crediting non-controlling interest. We're saying the credit, we're recognizing the portion of the subsidiary at acquisition equity that belongs to the non-controlling interest. So because P doesn't have whole ownership, it's not a wholly owned subsidiary, we have to recognize that the non-controlling interest owns 25%. Then we have our gain from bargain purchase. We are going to credit gain from bargain purchase with 10,000 Rand. This is the amount, so the parent paid less than what they got. So it has resulted in a gain on bargain purchase, And this is going to be recorded in the consolidated financial statements. It is an income shown in the statement of profit and loss. Okay, this is just an explanation of what I've said in the pro forma journal entries, okay? So the statement of profit or loss and other comprehensive income. So P acquired its interest in S on 31 October 2020. This is the last day of the financial year. So it will need to prepare consolidated statements of profit or loss and other comprehensive income for the period ended 31 October 2020 as part of its consolidated annual financial statements. The consolidated statement of profit or loss and other comprehensive income will only show 100% of P. And the reason is that it was acquired on the last day of the financial year. Therefore, no profits from S will be included in the consolidated financial statements. And then remember, we said that the gain on bargain purchase will also be included in the group's profit for the period ending, it was 31 October 2020. So the gain on bargain purchase is going to be recorded in the consolidated financial statements. And specifically, it's shown as an income in the statement of profit or loss and other comprehensive income. So the net profit or loss attributable to the non-controlling interest, this must be shown separately in the statement of profit or loss and other comprehensive income. The total comprehensive income attributable to the non-controlling interest must be shown separately in the statement of profit or loss and other comprehensive income for the year. So remember, when we looked at the consolidated statements of financial position, we added 100% of P Pty Limited and 100% of S Limited on a line-by-line basis for assets and liabilities. So the equity section, again, it will be split between the equity attributable to owners of the parent and the non-controlling interest. Okay, so here we have the statement of financial position, the consolidated statement of financial position. So we have P and S's property, plant, and equipment. So P had PPE of 123,000 Rand. S had 150,000 Rand in their separate financial statements. So we're simply adding P plus S. That will give us a consolidated figure of 273,000 in the consolidated statement of financial position. Then we have an investment in subsidiary. Remember, P showed 140,000 Rand as their investment in S, which is fine in their separate financial statements. But in the consolidated financial statements, we need to eliminate this. So the pro forma journal entry will be processed to eliminate this, resulting in 0 as the investment in the subsidiary. Then we have trade and other receivables. P had 117,000 Rand trade and other receivables in their separate financial statements. S had 86,000 in their separate financial statements. So we're simply adding 117,000 Rand plus 86,000 Rand, and that will give us 203,000 Rand trade and other receivables in the consolidated statements of financial position. Then we have equity. So equity here is going to be split between owners of the parent and the non-controlling interest. So for equity, we have share capital. P had 100,000 Rand and S had 80,000 Rand. And then remember the equity, the share capital in S was eliminated by a pro forma journal entry. So we're going to say share capital 100,000 in P plus 80,000 in S minus 80,000 in S. That will give us a consolidated share capital figure of 100,000. Then the retained earnings. So P had retained earnings of 240,000. S had retained earnings of 120,000. And then remember, we had the gain on bargain purchase. So the gain on bargain purchase is shown in your consolidated statement of profit or loss. Now, remember that total profits from that statement comes to retained earnings. So on consolidation, we're showing plus 10,000 Rand gain on bargain purchase here in the line item for retained earnings. Then remember, we processed the pro forma journal entry. We debited retained earnings. So here we are simply eliminating the equity in S. So we're saying 240,000 plus 120,000 in S minus 120,000 in S plus 10,000 gain on bargain purchase. And that gives us total retained earnings in the group of 250,000 Rand. Then we have non-controlling interest. So the non-controlling interest is 50,000 Rand. This was part of our pro forma journal entries. So that gives us total equity. Remember, we split it. 350,000 Rand is attributable to owners of the parent, and 50,000 Rand is attributable to the NCI. Then we have trade and other payables. Pty Limited had 40,000 Rand and S had 36,000 Rand, and this gives us a total of 76,000 Rand in the consolidated financial statements. Okay, so this is our consolidated column. And remember, I said you must show your workings, okay, because all the workings will be for part marks. Okay, so now in example 3, Pty Limited earned a net profit after tax of 180,000 Rand in the period ending 31 October 2020 and declared and paid dividends of 20,000 Rand. S earned a net profit after tax of 60,000 in the period ending 31 October 2020 and did not declare any dividends. So here we have our consolidated statement of changes in equity. Remember, share capital and retained earnings in these two columns. This is the parent. So P had 100,000 opening balance of share capital and 100,000 closing balance of share capital. Then we have retained earnings of the parent. The retained earnings had a closing balance of 250,000 Rand. And then remember, it said on the previous slide that they had net profit of 180,000 Rand and dividends of 20,000 Rand. So the total comprehensive income is 180,000 Rand plus the gain on bargain purchase. Okay, so we have that gain on bargain purchase. And we have the dividend paid of 20,000 Rand. So when we add the share capital plus the retained earnings, that will give us this column here, equity attributable to owners of the parent. So we're saying 100,000 share capital plus 80,000 retained earnings. That gives us 180,000. Then we have total comprehensive income, 180,000. So that will be shown here in the total column. Then we have the gain on bargain purchase, which was 10,000 Rand. And then, okay, the dividend paid should also be here. So then we have our non-controlling interest column. So the non-controlling interest will be shown. Remember, it wasn't a subsidiary on the first day of the year. The acquisition only happened later on. So we're showing the acquisition of 50,000. And then the total equity column here will be the equity attributable to owners of the parent, 180, plus the NCI. That will give 180,000 total equity. We have the total comprehensive income and gain on bargain purchase. That will equal 190,000 in the total equity column. Then we have a dividend paid, which is 20,000. Then we have our non-controlling interest arising on acquisition. And then we have our final total in the total equity column of 400,000 Rand. Okay, so that is the end of the lecture, guys. So you'll see that some of the lecture examples, they seem repetitive, but I think it's just to instill the principles in you. There is like a process you need to follow when you do the consolidation. You need to calculate your analysis of owner's equity, that table. You need to do your pro forma journal entries before you do the consolidated statements. Okay. There's a question here, Coquette. So can you please explain why is the retained earnings 8,000 instead of 26? Okay, I think there must have been a previous example. The reason why the retained earnings was 8,000 Rand, I believe you're looking at the statement of changes in equity, the opening balance and the closing balance. Okay, so in the trial balance, the figures they gave us were closing balances. So that 26,000 was a closing balance because it's at the end of the year. But that 8,000 Rand you're talking about is the opening balance, and you had to work backwards to get there. Okay. So let me just stop the recording. You guys are welcome to ask questions in the chat. Okay, so that is the end of this week.